Hello YouTube, welcome back to a new midweek video from the accounting tutor. I've decided to change things up a bit and will attempt to release 2 videos a week going forward. The video on the weekend will go through some of the simpler topics in accounting, whereas the midweek videos will cover some of the more difficult areas and areas which are often incorrectly done by individuals within the accounting industry. So, for this first midweek video, I'm focused on accounting for cash dividend payments. This is one question or one area which I'd say is answered incorrectly 80% of the time when we do technical accounting tests during our recruitment process. It's also one of those areas which is quite important to get right because of the legal ramifications if it's wrong. So during this video, I'll also give you the answer to how we account for cash dividend payments first, in case that's all you want to know out of this video. But if you want to find out the reasons why it's accounted in this way, then keep watching the video and we'll cover it after the 2-minute mark. So, let's dive straight into it, and let's go through the accounting for cash dividend payments. Well, the overall answer is you have to debit your retained earnings or accumulated profit, credit your cash, or if it's a final dividend only, your dividend payables. Another way to put this is your retained earnings or accumulated profits go down, and your cash will go down, and your dividends payable, if it's a final dividend, goes up. Now, why is this? Why is it going to retained earnings is the question a lot of you may be asking. Well, for that we need to figure out what a dividend really is first. A dividend is defined as a distribution by a company from its accumulated profits to the shareholders of the company. Okay, a distribution by a company from its accumulated profits to the shareholders of the company. Now, there are a few things, firstly, that you need to be aware of. The company itself can be a limited or an unlimited company. Cash dividend payments are not relevant for sole traders, for partnerships, or LLPs. However, for a company there is something to be aware of. For dividend payments to be able to occur, the company must be limited or unlimited by shares. It cannot be a limited company by guarantee. Now, you may not have heard that term before, so let me just quickly define what the two are. So in this case, we're talking about companies that are incorporated in the United Kingdom, the Republic of Ireland, and other Commonwealth countries. Within this incorporation, the company is a separate legal entity to the owners. Now, that's shared between companies that are limited by shares and limited by guarantee. However, companies limited by shares issue shares to its owners when they are set up, and the company themselves is therefore owned by the owners of the shares. When we say they are limited by shares, it's because the liability of the shareholders to any creditors of the company is limited to the capital that's originally invested or later invested into the shares of the company. And this is what makes up the share capital and the share premium. This is why share capital and share premium are non-distributable reserves, which means they cannot be distributed out as a dividend at any point. An unlimited company by shares is pretty much the same as a limited company by shares, except for the fact that the limit of the liability that can be brought upon the company is not limited to the share capital and share premium of the company. So any amount of liability can be brought against the company. Now, how is a company limited by guarantee different? Well, in the case of incorporating a company, there are no shares that are distributed to the owners on incorporation. Instead, the owners of the company are guarantors. So the liability of the company to creditors is limited to the amount that's guaranteed by the guarantors. Now the key here is, as the company has no shareholders, it cannot pay a dividend. But luckily, in most cases within the UK, a private or a public company is usually going to be limited by shares. So, returning back to the definition, a dividend is a distribution by a company from its accumulated profits to the shareholders of the company. We've defined what the shareholders of the company are. They're the owners of the shares of the company. Now it's key to define what it means by accumulated profits and where this idea that it has to come out of accumulated profits comes from. Well, where it comes from is the Companies Act 2006, specifically Section 830 of the Companies Act. And Section 830 says, 1. A company may only make a distribution out of profits available for the purpose. And 2. A company's profits available for distribution are its accumulated realized profits so far as not previously utilized by distribution or capitalization, less its accumulated realized losses so far as not previously written off or in reduction or reorganization of capital duly made. Now, we aren't going to cover all areas of that. We're not going to talk about the difference between realized and unrealized profits. But the key, the most important bit to understand in that is a company's profits that are available for distribution are its accumulated realized profits less its accumulated realized losses. And this is the thing a lot of accountants get wrong, because they usually treat dividends in the following way. They will go debit dividend expense in the profit and loss and credit cash or dividend payables in the balance sheet. And the reason they do that, and this is usually for smaller companies who pay out a dividend every year to their shareholders, they have this profit element that they make every year, which they can just keep passing on to their shareholders, and so they think that it's just a reduction of that current year profit. But it isn't, and I'm going to show you why doing it that way is wrong and could lead to problems later on. Okay, so we're just going to go through an example of why we need to look at it from an accumulated profit standpoint in the balance sheet of what's going on in reserves rather than what's going on in the P&L for a given year. Okay, so let's look at a company X, year 1. The company made a loss of £5,000. Now, this could be because of startup costs, they're just kicking off a business. So at the start of year 1, they had accumulated losses of £5,000. In year 2, the company made a profit of £4,000. Directors are happy, there's excess profit for the year, they can finally give themselves a dividend. But if they did that, this dividend would be unlawful. Now, why is that? Well, at the end of year 2, the actual accumulated losses for the company are £1,000. So they haven't got any accumulated profit. they've still got accumulated losses of £1,000. And this is because they had a 5,000 loss from the first year and a 4,000 profit in the second year, which makes negative £1,000 loss. And as per the Companies Act, dividends can only be paid from net accumulated profits of the company. So they cannot pay out a dividend in the second year, even though they've made a profit in that year. Now, let's look at year 3. In year 3, that same company made a profit of £6,000. Now the directors are like, okay, this year we're definitely going to take a dividend. We made a profit of 4,000 last year, made 6,000 this year. We have 10,000. We can pay that 10,000 dividend. We have no issues. There is an issue, because the maximum that they can pay out is a £5,000 dividend. Now, why is that? That's because at the end of the third year, the accumulated profits were actually £5,000. So they can only pay a maximum dividend out of £5,000. Now, where does that come from? Well, they made a £5,000 loss in the first year. They made a £4,000 profit in the second year. So accumulated loss as at the end of year 2 was negative 1,000. And then in the third year, they made a profit of 6,000, which means they went into accumulated profits of £5,000 as at the end of year 3. So they can now pay out a dividend of up to £5,000. Now, this is based on certain caveats. The first is, and this may seem obvious, the company needs to make sure it has enough cash to pay out those dividends. If it doesn't, then there's no point in declaring a dividend, because you don't have any cash to pay out. Now, we'll cover in other videos different types of dividend payments that can occur, because you can transfer non-cash dividends up to your shareholders. But we'll cover that later. And the second caveat to all of this, and again it may seem obvious, but we need to make sure that no previous dividends have been paid out. Now, because there is a requirement to pay dividends out of whatever you call it, accumulated profits, retained earnings, reserves, because we have to do that as per the law, is the reason why we have to account for dividends through retained earnings and not through the P&L. Okay? So we know that it's definitely going to be debit retained earnings or accumulated profits or reserves, whichever one, but it's within reserves in the balance sheet. And then we're either going to credit cash or we're going to credit dividend payable. And that is dependent on the type of dividend that you are declaring. And there are really two types of dividend which we're going to focus on. The first one is an interim dividend. An interim dividend is a dividend that can be declared by the directors outside of their AGM. This means that they do not need shareholder approval in order to declare these dividends. So the directors must satisfy themselves that the company's current financial position warrants the payment of these dividends, i.e., as at this point in time, does the company have enough retained earnings or accumulated profits to pay out these proposed dividends? Okay? But only a director's resolution is needed to pay out these dividends. Now, in this scenario, an interim dividend can only be recognized when it's been paid. And that is because it's just a director's resolution. There is a risk that the dividend payment can be stopped by the directors at any point. It is not virtually certain that this is going to occur. And therefore, it cannot be recognized on declaration. It has to be recognized when it's paid. So for interim dividends, you will go debit retained earnings, credit cash on the date that the dividend is paid. The second type of dividends are final dividends. These are dividends declared by the company after the end of its financial year end and are with the approval of the directors in the AGM as well as the shareholders in the AGM. Because this is more formal and because it's received shareholder approval, it is virtually certain that this is going to be paid out, and therefore final dividends can be recognised on the date they are legally declared. So at that point in time we can go debit our retained earnings and credit dividends payable, which is a current liability within the balance sheet. And then when it's paid out, we will go debit our dividends payable, so debit the current liability and credit our cash. The last thing to remember in this video is that dividends are paid to shareholders in proportion to the shareholding that they own in the company. So if two individuals own 50% each of the shares in a company, and the company declares a total dividend of £10,000, that means each person is due £5,000 dividend. Just be aware that if you work in group accounting or in the accounting function and you have nominee companies that you're setting up as shareholders for certain other group companies that hold one or a nominal share value, that if dividends are being paid up, then they are also legal recipients of those dividends and beneficial recipients of those dividends. So you may want to waive the right of those companies receiving a dividend so that 100% of the beneficial dividend goes elsewhere. It prevents, £1 or pences worth of dividends being paid to these nominal shareholder companies. So that's really it for this video. So just as a summary, a dividend is a distribution by a company from its accumulated profits, which is a distributable reserve, to the shareholders of the company. And the company has to be an unlimited or limited company by shares. Accumulated profits are all of the previous profits and losses that the company has made netted out. And this means that when we do the accounting for the dividend, it has to be debit to retained earnings or accumulated profits, but it has to go to reserves within the balance sheet, and we have to credit cash if it's an interim dividend, or dividends payable as current liabilities if it's a final dividend payment. If it's interim, then we record the dividend once it's paid. If it's a final dividend with AGM and shareholder approval, we record the dividend when the dividend is payable. Now, thank you very much for watching. There are certain areas which we haven't covered in this video, which are things that are going to be discussed in future videos. So we'll go through in more detail what the difference is between distributable and non-distributable reserves. And then I also mentioned that there are dividends which are not usually cash dividends, which are called dividend in species or dividends in kind. We'll go through how they work. We'll also go through stock dividends or stock awards, restricted stock awards, and also then preference shares and preference dividends, and other types of shareholdings that cause different types of dividends or voting rights to exist in a company. So all of that to look forward to. And finally, I just want to say thank you. Thank you for watching this video. Please, if you have enjoyed the video, if you found it useful, press the like button, share it. Please subscribe to the channel and like me on Instagram or on Facebook. Under Instagram, I'm the accounting tutor, the.accounting.tutor. And then my Facebook page is long, but I've added the link there. And then if you want to support me doing these videos and for me to get better production quality, etc., or do a course in video production, then please support me on Patreon. The link is there on screen as well. Take care, and I will see you for the weekend video.